It is 3 a.m., and the most dangerous technical setup silver has produced in the entire 2026 cycle just closed on the weekly chart. The current price of silver is $80.58 as of March 15, 2026. The long-term uptrend remains intact, but the price is still below the key levels of $80.48 and $80.87, so the market may continue to move sideways. XS, $80.58. Sitting right on top of the single most important technical level in the entire silver market, the level that every institutional desk, every technical analyst, and every primary source this channel has tracked for 6 weeks has identified as the exact line between the bull case and the bear case for 2026. And here is why this specific close, $80 on a Saturday morning, is the most dangerous setup of the year. Not because silver is definitely going lower, but because the next 5 trading sessions will determine whether the 41% decline from $121 produces a higher low and a bull market resumption, or whether it produces something that almost nobody in the silver community is talking about right now. Before we go any further, if this is the first time you have found this channel, you need to subscribe right now, not after the video. Right now. Because the analysis in the next 6 minutes is the kind of framework that changes how you read every silver headline for the rest of 2026. Hit subscribe, hit the bell for all notifications, and drop your number, bull or bear, in the comments right now. Are you holding at $80, or are you watching from the sideline? Drop it below. Let's go. Let me show you why the $80 close is specifically dangerous. Not generically dangerous, but dangerous in a precise, technically documented, primary source confirmed way. The $80 level is currently the line in the sand. As long as XAG USD holds above this zone, the macro bullish structure remains intact. Immediate resistance. To confirm the next leg of the bull run, silver must reclaim the $94 level. A weekly close above this mark opens the door for a retest of the $121.62 all-time high, bullion vault, line in the sand. That is KuCoin's published characterization, and it matches exactly what JPMorgan's technical analysts said on March 5th, exactly what FXEmpire's chart analysis confirmed this week, and exactly what Vantotrade's institutional framework identified in January. 5 independent analytical frameworks, all converging on the exact same dollar level, $80, as the threshold that separates the bull structure from the bear structure. The market is laser-focused on the $80 psychological level. If silver fails to hold this support, technical analysts at JPMorgan suggest a worst-case correction floor could sit near $68. JPMorgan, $68. That is the specific number that JPMorgan's technical desk identified as the worst-case floor if $80 fails. From 80 today, 68 is a 15% decline. In a market that moved 13% in a single Monday morning session 3 weeks ago, 15% is not a distant scenario. It is a single bad week. A break above $84 is required to negate the bearish development and indicate further upside towards the $100 area. However, a break below $70 in the spot silver market will confirm the double top pattern and indicate a downside move towards the $65 to $60 area. Finance magnates. Double top pattern. FXEmpire's published technical framework identifies a double top formation, with peaks at $49.81 in 2011 and $121.67 on January 29, 2026. That confirms a bearish target of $60 to $65 if $70 breaks, not 68, not 65, 60 to 65, and the confirmation trigger is not $80, it is $70, which is 10 points below today's close. That is the technical danger. Now let me show you the volatility danger, because the technical setup is only half of what makes the $80 close the most dangerous setup of 2026. VXSLV at 72.77 with elevated call structure in the $90 to $105 range, 82nd percentile volatility, supports large directional moves. Record SLV short per the February 20th COT creates asymmetric squeeze mechanics, though contrarian positioning carries inherent reversal risk. CoinCodex, 82nd percentile. Volatility is at the 82nd percentile of its entire historical distribution. That means silver's current volatility is higher than it has been 92% of all trading sessions in the recorded history of the market. And when 82nd percentile volatility meets the exact line in the sand support level, when the market is this volatile and this close to this important A level, the directional move that follows is not a gradual drift. It is a decisive, high-velocity, large-magnitude move in one direction. The record SLV short in the February 20th QOT report is the asymmetric element, the short squeeze potential that sits on the other side of the danger. If $80 holds and silver begins recovering toward 84, the record short position that accumulated during the March correction becomes the fuel for a violent short squeeze rally. Every short that covers to protect profits adds buying pressure. Every buy stop triggered above resistance levels adds momentum. The squeeze mechanics are documented and confirmed, but that squeeze only activates if $80 holds, and $80 holding depends on the three macro forces that pushed silver to 80, DXY near 100, Fed cut expectations pushed to September, and Hormuz de-escalation rhetoric, reversing or stabilizing before the Asian session opens Sunday evening. Now the most important question, what does the bull structure require, and is it still intact? A move back above that level would signal that the market has regained bullish momentum and could reopen a test of the early March highs near $96. For now, silver appears to be entering a consolidation phase after an extremely volatile start to the month. The broader bull trend that began in late 2025 remains intact, but the market is likely to remain sensitive to shifts in the dollar, interest rate expectations, and investor positioning. SBC Gold remains intact. That is Shanghai Metals Market's published assessment, citing the exchangerates.org.uk analysis from March 7th, that the broader bull trend that began in late 2025 is still intact at $80. Intact but fragile. Intact but sensitive. Intact but sitting on the exact support level where fragility becomes fracture if any of the three macro forces applies additional pressure before the structure can rebuild. Technically, on the 4-hour time frame, silver is currently testing the high trade node area between $82.43 and $83.64, following a volatile reversal from its recent higher high. This price action has triggered a change of character to the downside, indicating that the asset is seeking to stabilize and discover liquidity after a rapid descent toward the most recent low. On the upside, if silver gained, it attracted buying power from the HTN, which may turn buyers' eyes to the bearish fair value gap between $87.72 and $88.17, which aligns closely with the 0.5 Fibonacci level at $87.17. Gold-silver, change of character. That is the specific technical event, published by XS.com's institutional analysis this week, that the $80 close has triggered on the 4-hour chart. A change of character is not a trend reversal. It is the market's signal that the previous directional structure has been interrupted and that the next move requires confirmation before the prior trend reasserts. The specific confirmation needed: a sustained close above $84 on volume, reclaiming the high trade node and negating the bearish CHOCH signal. Support levels at $69 to $70 and resistance at $82 to $84 serve as important references for investors, with the potential for a breakout to $85 to $90 under optimal market conditions. In a bullish scenario, a combination of strong fundamentals, high industrial demand, and positive market sentiment could push silver prices to $85 to $90 per ounce. A moderate or base case scenario projects prices in the $70 to $80 range, consistent with stable demand trends and ongoing supply deficits. A bearish scenario remains possible if the US dollar strengthens or investors shift focus to high-yield assets, causing silver prices to drop to $60 to $70 per ounce. The Street. 3 scenarios. Bull, 85 to 90. Base, 70 to 80, exactly where silver closed today. Bear, 60 to 70. And the close at 80 is the exact boundary between the base case and the bear case, not comfortably inside the base case, not approaching the bull case, sitting on the dividing line between them with 82nd percentile volatility and a record SLV short position creating the conditions for a decisive move in either direction. Watch Sunday evening Eastern. The Asian session open is the first real money verdict on whether 80 holds as support or breaks as resistance turned floor. Watch the DXY on Sunday. If it pulls back from 99.7 toward 97, the mechanical headwind that pushed silver to 80 relieves simultaneously. Watch the $84 level on any Monday recovery attempt. A sustained close above 84 with volume is the specific signal that the CHOCH has been negated and the bull structure has resumed. And watch $70, the double top confirmation trigger, as the level whose breach changes the technical conversation from consolidation to structural reversal. Growth scenario, Long trades can be opened once the price exceeds $81. Bullish targets are $92 and $100. A sell signal will appear if the price falls below $65. In this case, the nearest bearish target is $48. Excess. 81 is the gate. 92 and 100 are the sequential targets above. 65 is the structural failure level. 48 is the bear target below that. The entire 2026 price distribution, from $48 to $229, as Light Finance's aggregated analyst range confirms, is still in play. And today's close at 80.58 cents puts silver 31 cents above the gate that separates the two halves of that range. Silver's $80 close may be the most dangerous setup of 2026. The line in the sand is drawn. The volatility is in the 82nd percentile. The record short position creates the squeeze potential, and the next 5 sessions will produce the answer. This is financial warfare education, not advice, not signals. Verify before you act. Invest with logic, not hype. OG John AG, out.